Thanks, Galen, for the introduction. Good morning. It's my pleasure to be here today to join you for your 106th annual meeting. At the board, we do everything from a technical matter in public, but every now and then we have to have private meetings to talk about administration, to talk about strategy, to talk about what each of us are doing on a daily basis. And about 3 weeks ago, I told my fellow board members that I had the opportunity to come here today and speak to you about the future of GAAP. And as you know, there's always one in a board that has to ask more questions and probe. And so the one in the board said, well, where is the conference? Now, I think he probably knew where the conference was. So I said, of course, Maui. And the other ones went, really? You get to go to Maui to talk to NASBA. Why are you going all the way to Maui to talk to NASBA? And I says, well, Billy's going to be there. Diane's going to be there. It's really important to continue to build relationships. They said, So again, there's always one who has to audit everything you say. So exactly how are you going to continue to build relationships? So I talked to them about the opportunity I was going to have to go golfing with Billy, with Carlos, with Bill Belhoff from the AICPA. And I say, this is a great opportunity for the chairman of the FASB, the chairman of the PCC, the incoming chair of NASBA, and the chairman of the AICPA to have a social relationship, to talk about, to get to know each other on a personal level, and to talk about matters of personal interest. Would anybody like to guess how long it took to bring up the PCC matters? Do you think it was at the breakfast, the turn, the first hole? It was in the shuttle van on the way over to the course. So I'd like to spend some time with you today to talk about the future of generally accepted accounting principles, or what we know as GAAP. Specifically, I'd like to share some thoughts about the challenges faced by the FASB in exercising its responsibilities to both preserve and evolve GAAP standards. I'd like to discuss how we are dealing with that responsibility for all of our stakeholders, including international and private company constituents. But before I begin, let me remind you that the remarks I'm about to give you today are my own and do not necessarily reflect the official position of the Financial Accounting Standards Board. But this is for Carlos. They do reflect the views of the chairman. Also, I want to let you know that I am particularly honored to have been asked to join you today, because I consider our 55 state boards of accountancies to be the linchpin of the accounting profession in the United States. In setting a high bar for admission to our profession, our state boards are dedicated advocates for the public interest. They promote ethics and integrity, and they provide strong leadership on critical issues facing the accounting community. I have the privilege of being licensed in Washington State. This is where you're supposed to clap. There you go, okay. All right. I started my career in Washington. I also have the privilege of being licensed in Connecticut. Where's Connecticut? There you go, all right. I knew there was only one. I couldn't find you earlier, so nice to meet you all. This is not the area, but I am, when my CPE comes up, I hope you take a real strong look at that and make sure that, but I'm in good standing. In my more than 20 years in the profession, I have been impressed repeatedly with how well our state boards of accountancies do their very important jobs. So about 6 weeks ago in New York City, the FASB and the Financial Accounting Foundation sponsored a thought-provoking conference marking the 40th anniversary of the FASB. One of the highlights was a panel discussion that brought together 5 of my 6 predecessors, all but the first FASB's chairman, Marshall Armstrong, who passed away a few years ago. During the course of the panel, each of the former chairs described in detail the major challenges that they faced during their tenure. For Leslie Seidman, it was derecognition, when to take assets off the balance sheet. For Bob Hers, it was Sarbanes-Oxley legislation and the redesignation by the Securities and Exchange Commission of the FASB as the public company standard setter. Bob also cited the financial crisis of 2008 and 2009 and the second great debate over expensing stock options. For Ed Jenkins, it was the involvement of Congress in the controversy surrounding accounting for derivatives. For For Denny Beresford, it was the first battle over the FASB's proposal to expense stock options, a battle the board lost then but later won. And for Don Kirk, a member of the original board and our second chairman, the principal challenge of his tenure was survival in the face of political pressure. The discussion centralized for me some important truths about GAAP. GAAP lives and breathes. It is never finished. It establishes unifying principles while recognizing appropriate differences. It is both powerful and vulnerable. Most importantly, the members of the FASB are not the masters of GAAP, but we are its stewards. Maintaining GAP's strength requires the dedication and commitment of all who believe in it and find it valuable. That group, of course, includes the members of the FASB, but more importantly, it includes all of the stakeholders who are served by GAAP. Together, our mission is to both maintain and improve. While we must preserve what makes GAAP strong while enabling GAAP to evolve to meet demands and address new situations. When the FASB established its conceptual framework some years ago, it set forth a key principle. General purpose financial reporting is supposed to provide financial information about companies and other organizations that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing capital to those companies and organizations. The fundamental characteristics of useful financial information are relevance and representational faithfulness, the board said. The utility of relevant, faithfully presented information is enhanced if it is comparable, verifiable, timely, and understandable. Put another way, the FASB is responsible for promoting financial reporting that enables investors and creditors to evaluate financial information consistently over time and comparably among different companies so that they can best decide how to allocate their capital. That aspect of our mission implies consistency and argues against too much change. At the same time, the FASB has the responsibility to promote financial reporting that is and remains relevant to investors and creditors as companies and the economic environment evolve over time. Relevance comes in many forms. It means recognizing that particular circumstances, culture, and needs of different investors, companies, industries, and jurisdictions. It means reducing complexity and promoting simplification. And it means evaluating the potential benefits of a new standard and determine whether those benefits justify the cost of change. Finding the right balance between maintaining comparability and increasing relevance, I believe, strengthens GAAP. A strong GAAP delivers important benefits to investors and creditors, to the companies to which they entrust their capital, and to our national and global economies. Economic ebbs and flows notwithstanding, the growth and expansion of our economy during the past 150 years has been aided, in my view, to a significant degree by improvements in the way businesses have reported their financial results. As America's transportation links were being forged, railroad companies pioneered standardized financial reporting to attract both public and private capital. More standardized financial reporting in the late 19th and early 20th centuries helped develop the nation's steel manufacturing industries, and at least some of the expansion of the U.S. automobile industry in the 1920s has been attributed to accounting modernization. On the other hand, the failure of companies to report comparable and relevant information played a role in our worst economic crisis. The pivotal economic event of the 20th century, the Great Depression, focused the U.S. on the need for comprehensive financial reporting reform that would require all companies that offer stock to the public to adopt better accounting practices. Reforms put in place by Congress led to the creation of the Securities and Exchange Commission, which of course has recognized the FASB standards as GAAP for the nation's public companies since 1973. In today's world, with unprecedented access to financial information via the internet, the need for comparable and relevant financial information is greater than ever. Without clear standards and an open, independent process for creating and improving these standards, financial information would be more opaque, and capital formation around the world would be less efficient. That in turn could drive up costs for all sectors of our economy. So why has GAAP been so successful? Financial statements prepared in accordance with GAAP are clear. They are comparable and they are reliable. They can easily be compared with the GAAP financial statements of other companies. They can easily be audited and verified by third parties in accordance with established standards. They can ease the transition of companies from public to private status. They are universally understood by lenders and investors. As a result, they play a critical role in helping a company or organization raise new capital. Finally, GAAP standards are created through a world-class, comprehensive, independent process that encourages broad participation, objectively considers the views of all stakeholders, and is subject to an appropriate level of oversight. I'd like to spend the next few minutes discussing what the FASB is doing to preserve the core mission of GAAP and ensure that it evolves to remain relevant, both internationally and here at home for both private and public companies. On both fronts, our guiding principle is to try to find common ground while recognizing that in some cases we may need to maintain some differences. In the case of international standard setting, we are trying to achieve greater comparability while identifying and acknowledging those areas where there are or may be different needs. Those needs may arise because of, for example, a different business culture, a different legal or regulatory requirement. In the case of domestic standard setting, we are trying to identify those areas where there are different needs based on different types of companies. Even as we strive to minimize differences, we believe that we must first serve the users of GAAP financial statements while making sure that GAAP illuminates any differences whenever and wherever they occur. Let me spend a few minutes talking about what we are doing in the international front. Since the Norwalk Agreement was signed in 2002, the FASB and the International Accounting Standards Board have been working together under a series of bilateral arrangements to more closely converge GAAP and international financial reporting standards. I think this 11-year effort has been a major achievement. Developing and preserving more comparable and converged global accounting standards will remain a critically important goal. However, with the end of the era of bilateral convergence, it is important that we ensure GAAP standards remain relevant to investors and creditors in the U.S. capital markets. Through the next year, the FASB's top priority will be to complete our major convergence projects. We in the ISB hope to release a final standard on revenue recognition early next year. We plan to issue final improvements to our two financial instruments projects, impairment and classification and measurement, in the middle of 2014. A final standard on leasing should be completed by the end of 2014, and any improvements on insurance thereafter. As this process has been progressing, the Securities and Exchange Commission has been weighing a public policy decision on the appropriate role for domestic issuers of IFRS as established by the ISB. At the FASB, we have been discussing a long-term vision for global standard setting in which the FASB, the ISB, and other major capital market standards coexist and cooperate. The goal would be to develop converged standards while also addressing the specific needs of the individual capital markets for which these organizations set standards. The FASB's first priority is to improve financial reporting for the benefit of investors and other users of financial information in our own capital market. In addition to serving our capital markets, the FASB's work will benefit others. Among those who benefit from this work are standard setters and regulators in other major capital markets that use or reference U.S. GAAP, and the stakeholders of companies that issue financial reports in those jurisdictions, including Canada. Where's Canada? I know Canada's here. Canada's over there. Okay. While working to improve GAAP, the FASB also seeks to promote and enhance the quality, comparability, and consistency of international financial reporting. Just take a look at IFRS. You'll see that the intellectual capital that underlines the FASB standards serves as the foundation of many of the IFRS standards. Reducing global differences in financial reporting, however, is dependent on more than simply reducing differences in financial accounting standards. As others have repeatedly pointed out, significant differences continue to exist in the auditing and enforcement of financial reporting in jurisdictions around the world. Therefore, broader or more complete convergence of financial reporting cannot be accomplished through financial accounting standards alone. I believe the FASB can successfully carry out its mission of improving financial reporting for the U.S. capital markets while also seeking to improve and converge financial reporting internationally. First, through the development and improvement of U.S. GAAP. Because the FASB's objective is promoting and reporting highly relevant information for financial statement users of companies using GAAP, the FASB should continue to undertake improvements of GAAP when necessary to meet the needs of investors and other users of companies preparing GAAP reports both within and outside the United States. The FASB should, as a starting point, carefully evaluate and consider IFRS when implementing improvements to GAAP, seeking to promote global alignment where it is in the best interest of our investors and other capital market participants. Any improvements that the FASB makes to GAAP may also influence the shape and future direction of international standards. Second, I believe we should actively participate in the development of IFRS. The FASB should advance the development of IFRS by actively providing input on ISB projects through the recently created Accounting Standards Advisory Forum and through other means. The FASB should contribute to the development of IFRS by sharing views, developed through our due process, our stakeholder outreach, our analysis, our public meetings. Likewise, the FASB's effort to improve GAAP will benefit from the additional international input resulting from its interactions with the IASB, the International Forum of Accounting Standard Setters, and other world standard setters. In all instances, the FASB's objective will be to promote the improvement and convergence of GAAP and IFRS. Third, I think we need to enhance relationships and communications with other existing national standard setters. The FASB should maintain and strengthen its existing cooperative relationships with other national standard setters to promote the broader flow of information and ideas that mutually inform each other's thinking. I think that will contribute to an environment that will foster greater convergence. In particular, the FASB will seek to enhance relationships with those standard setters representing countries with a large number of foreign private issuers within the United States. This type of cooperation and collaboration would continue the process of developing the highest quality standards while promoting global convergence. In some cases, the need to serve the best interest of investors in our own capital markets could outweigh the goal of creating completely converged accounting standards. But following this path would enable the FASB to work cooperatively with the ISB and others towards the goal of ultimately agreeing on and adopting standards that are either converged or have the fewest possible differences. Working together, we can create a new path forward in the quest for more common and comparable global financial standards by working individually to improve our own national standards, by working with the ISB on continual improvement to IFRS, and working with each other on individual projects and to identify best practices in standard setting. This would result in a new decentralized multilateral model of international standard setting that is consistent with the goal of promoting greater convergence in global financial accounting standards. Yet even as we stay committed to global convergence, we must continue to address the pressing needs of users in our individual capital markets. I'm glad you had bottled water over there. To that end, the Financial Accounting Standards Advisory Council, or FASAC, recently undertook a survey to gather information about potential new agenda items for the FASB. With the completion of the convergence projects, the survey is intended to provide valuable feedback to the FASB as we decide on our future projects. The survey asked stakeholders to share the views on projects' priorities and included open-ended questions to provide an opportunity for respondents to elaborate on the areas that they believe are most important for the FASB to address. The results from this survey will help the FASB to decide whether, and if so, how, to proceed with, first, projects that have been on our back burner, such as financial statement presentation, financial instruments with characteristics of equity, and the conceptual framework. Issues that have been the focus of news stories and commentaries, such as pension accounting and hedge accounting. Potential convergence items, including whether the FASB should incorporate specific areas of IFRS into GAAP. And finally, issues with existing standards arising from information gathered during the FAF's post-implementation review projects and PCC-sponsored roundtables around our country. As we work together to identify projects to add to our agenda, as the so-called convergence projects are completed, we will look to other countries for assistance and guidance. Now more than ever, we believe it is critically important that any proposed improvements to GAAP are informed by those who set standards in capital markets where GAAP is used. Let me move now to our domestic agenda, specifically what we are doing in the area of private and public companies. As you know, the Financial Accounting Foundation in May of 2012 created the Private Company Council. The council was established to work with the FASB to better address the concerns of private companies in the standard setting process. This action was preceded by years, literally years, of discussion and debate among a wide range of stakeholders. While the FAF Board of Trustees recognized that we at the FASB needed to do a better job of taking into account private company issues, they specifically rejected the call for a separate authoritative standard-setting body. Instead, they empowered the PCC to do two things. First, the trustees directed the PCC to take a look back at existing standards, to recommend whether any of them should be modified to address private company issues. And second, they empowered the PCC to look forward with the FASB as we develop new standards to ensure that private company issues are appropriately considered. But the trustees made it clear that the final decision on standard setting rests with the FASB. Since its first meeting in last December, the PCC has made significant progress in fulfilling its dual mandate. In the 5 meetings that it has so far, the Council has taken action on 4 issues that users, preparers, and auditors of private companies have identified as priorities. These issues are accounting for identified intangible assets acquired in a business combination, accounting for goodwill, applying variable interest entity guidance to common control leasing arrangements, and accounting for certain accounting for certain received variable pay fixed interest rate swaps. This is probably the section why none of the guests were allowed to this conference. They would probably leave after I read those 4. To date, the PCC has voted to finalize proposed GAAP alternatives for accounting for interest rate swaps and separately accounting for goodwill. In the coming weeks, the FASB will discuss these proposed alternatives and also consider the applicability of these alternatives to public companies and not-for-profit organizations. If the FASB decides to endorse the alternatives, they will be issued as a final accounting standards update. In November, the PCC will discuss stakeholder feedback on the proposal for applying variable interest entity guidance to common control leasing arrangements. I hope that the PCC will recommend to the board for our endorsement that this overdue improvement be made for private companies. The PCC has also been busy as a role as an advisor to the FASB on new projects. For example, the PCC has provided feedback on the FASB's projects for revenue recognition, leases, accounting for financial instruments, going concern, disclosure framework, definition of a non-public entity, and government assistance. The FASB, in my view, has responded positively to the PCC's work. Based on a recommendation from council, for example, we have added to our technical agenda a project to address financial reporting complexities for companies in the development stage. This project is not restricted to private companies. In fact, the scope relates to both private and public companies. It focuses on all companies in which planned principal operations have not commenced or have not yet produced significant revenue. Current GAAP requires development stage companies to present the same basic financial statements and apply the same recognition and measure requirements required for all companies. They must also present certain inception to date information in their financial statements. Stakeholders have raised concerns about the costs and relevance of these additional presentation requirements. Preparers and auditors talked about the costs, and when we asked the users, a lot didn't even know what a development stage enterprise was, and we viewed that as a data point that maybe they didn't need to know if it was a development stage enterprise. A proposed ASU on this topic has been cleared by the board and should be issued in the coming weeks. Similarly, we are beginning to do some research on issues involving share-based compensation and liquidity features commonly provided by private companies. We plan to begin thinking about these features. We plan to begin thinking about whether these features should be evaluated differently in an effort to improve and simplify the accounting. If you were to draw a lesson from the work I've just described, I hope it would be this. The FASB is first and foremost focused on identifying how GAAP can be improved, how GAAP can be simplified, and made more relevant for all companies and organizations. In cases where we believe it is appropriate, we likely will endorse differences for private companies. But in other cases, we'll look to incorporate the PCC improvements across the board. In other words, our effort and the PCC's effort is to develop a common body of standards under GAAP, not big GAAP and little GAAP, not private GAAP and public GAAP. It is the principle that is guiding our efforts to contribute to the development of a common, but not necessarily identical, body of global accounting standards. To help us with this work, we're creating some new tools. 6 months ago, the FASB and the PCC jointly issued an invitation to comment on an updated private company decision-making framework. Internally, we call it the Guide. The objective of this project is to develop criteria for the board and the PCC to use in determining whether and in what circumstances to provide alternative recognition, measurement, disclosure, display, and effective date guidance for private companies reporting under GAAP. When finalized, I believe the Guide will help both the FASB and the PCC identify the unique needs of users of private company financial statements, as well as the opportunities to reduce costs and complexity of preparing private company financial statements in accordance with GAAP. It would also help the board improve the relevance of those statements to users. We expect to issue a final document in the coming weeks. Separately, the board has been working on a disclosure framework project to improve the effectiveness of disclosures in the notes to the financial statements by clearly communicating the information that is most important to users of financial statements. Although reducing the volume of the notes is not the primary focus, we hope that a sharper focus on important, relevant information will result in reduced volume in most cases. You all have in your desk the annual report of NASB. I took a quick look at it. 2 pages of fair value disclosures, all level 1 and level 2. I'm pretty sure you're all users of NASB. I'm pretty sure the other users of NASB, and I'm pretty sure the first thing you thought of when you picked up NASB's financial statements was not level 1 and level 2 fair value disclosures of all of NASBA's securities. The Disclosure Framework Project comprises the following 2 components. First, the board's decision process and the reporting company organization's decision process. The intent of the second component is to enable individual organizations to exercise more discretion and flexibility in applying existing and future relevant disclosure requirements based on their particular circumstances. The board's decision process helps teach the board that we should allow flexibility, that we should not say the objective of disclosure is X, and then have 2 pages of standards that say thou shall, thou should, in order to comply with the disclosures. It is taught to help us understand how to provide more flexibility, and the second is to allow more flexibility for those preparing and auditing the financial statements. I'd like to take this time to mention that the PCC is in the process of hosting a series of roundtables with private company stakeholders to identify other issues of concern to them. The first town hall meeting will be held on November 4th at the Ohio State University, and the second will be held next May at the University of Washington. But let me pause here for a moment and give credit where credit is due about our private company initiative. Much of the FASB's understanding of private company issues is a direct result of the work undertaken by the American Institute of CPAs. For many years, the AICPA and its representatives have worked to help the FASB better appreciate the different needs of private companies and their constituents, and how those needs might be better served by GAAP. We owe the AICPA and its leaders a debt of gratitude for that contribution. As you all know, the AICPA took its concerns with private company issues a step further by developing and issuing a new financial reporting framework for small and medium-sized enterprises, also known as FRF for SMEs. The AICPA has appropriately characterized the framework project as an effort to create non-GAAP, a non-authoritative special purpose framework, otherwise known as Other Comprehensive Basis of Accounting, for smaller, owner-managed Main Street businesses whose lenders or investors do not require the comprehensiveness of GAAP financial statements. The AICPA's efforts has been controversial. NASBA, the Institute of Management Accountants, and the RMA Journal, that's the official publication of the Risk Management Association, have all cautioned potential users of the framework to fully understand its provisions and, more importantly, to recognize that FRF for SMEs is not GAAP. Before I go further, let me be clear. I will be the first person to tell you that GAAP is not for every company in our country. I understand that historically some organizations have found GAAP too complex and too costly. That is, it's not relevant to the needs of their stakeholders. I can understand why using a special purpose framework can be useful. I can understand why a cash basis OCBOA is useful. I can understand situations where a tax basis OCBOA can be useful. But it is important to remember that neither the cash nor tax-based OCBOAs were based on an existing GAAP framework. Add to that the smorgasbord of choices and options available under the FRF for SMEs, and the potential for confusion multiplies exponentially. And by the way, the confusion has already existed. Confusion could have consequences. GAAP is our national set of accounting standards. It serves the needs of both public and private companies, as well as the private sector not-for-profit organizations. Indeed, much of GAAP originally had its roots in common accounting and reporting requirements here in the U.S. involving public companies, private companies, and not-for-profits. Because of its general acceptance, GAAP is often the best choice for many private companies. As I mentioned earlier, financial statements prepared in accordance with GAAP are comparable, are reliable. They can easily be compared with GAAP financial statements of other companies. They can be audited and verified by third parties in accordance with established standards. And they can be universally understood by lenders and investors. If I were to choose one word to convey the benefits that the companies can reap in the marketplace through the use of GAAP financial statements, I would use the word trust. One primary reason why a private company would proactively choose to prepare its financial statements in accordance with GAAP is to lend credibility to its ability to measure and manage the results of its business activities. Capital providers have come to appreciate the fundamental qualitative characteristic that GAAP produces in financial statements and the discipline that GAAP requires. Preparers can generally realize a lower cost of capital by preparing their financial statements in accordance with GAAP. This is why I believe what private company constituents mean when they refer to as GAAP as the gold standard. Because GAAP-based financial statements are commonly accepted as credible by a wide variety of capital providers, companies that prepare their financial statements in accordance with GAAP gain flexibility in the types of capital available and in the number of investors willing to provide it. This can further lower the cost of capital because a variety of providers may be more eager to invest in a company that prepares financial statements in accordance with GAAP than those that do not. For companies that grow and think about various exit strategies, GAAP is the logical and likely only allowable reporting language for public companies, and likely the most strongly preferred language of sophisticated buyers. That is, if the equity sells to a financial or strategic buyer. One other aspect of GAAP that makes it the best choice for companies is its adaptability. Our continued efforts to improve GAAP, grounded in concepts, but also with an ear to stakeholders, allow GAAP to be amended, to grow, to evolve as businesses change with technology and economic cycles in a way that non-GAAP frameworks may not. In conclusion, let me reiterate. At the FASB, our job is both to preserve and evolve generally accepted accounting principles. We strive every day and at every board meeting to find the right balance between maintaining comparability, that is the common body, while working to improve relevance. That means we may, on occasion, recognize some differences. That principle guides our efforts both internationally and domestic fronts, and relevance comes in many forms. One aspect of relevance on which we intend to focus significant attention in the coming years is reducing complexity and promoting simplification of GAAP for all of our stakeholders. As the discussion at our FASB at 40 conference underscored, intelligent people often have divergent views. If you've ever observed a board meeting, you would understand that statement. But after that day-long event, I came away with a strong view that all former FASB chairs, board members, staffers, and others who attended agreed on one key proposition. GAAP is here to stay. Just as long as we at the FASB work to serve the needs of our stakeholders and our capital markets by preserving the core of GAAP while enabling it to evolve to meet the needs of future generations of investors, creditors, and companies. Thank you very much for the opportunity to speak with you today. I'd be happy to answer any of your questions.
If you could please come over to the microphones then.
The mic works.
Thank you for being here, Russ. My name is Mark Harris from Louisiana. Appreciate your comments about the financial reporting framework, and I apologize if I missed it, but I didn't see FASB offering any comments during the exposure period, and I'm just really curious as to why not.
Welcoming comments on the financial reporting framework during the exposure period? We had an internal team that had reviewed it in advance. We had a good dialogue with the senior leaders of the AICPA to provide input into their process, and I thought the dialogue was open. But the AICPA had provided an opportunity for people to comment. We didn't feel it was necessary that we engage in the comment process, other than by providing feedback that they had asked us to provide.
Oops. Nathan Garrett, North Carolina. I was recently reviewed, did not pour over the update with regard to the issue of the going concern presumption. And I did not see in the report, or maybe I just overlooked it, but what role, if any, did the PCC play in either your exposure draft or that will be played prospectively before you make your decision with regard to that update?
The going concern project is one that seemed rather easy at the time we took it on. We took it on years ago because we wanted within the codification to have all things GAAP. And as you know, going concern was in the auditing literature, but yet there were disclosure requirements that companies had to do, and so we felt it was important to bring it into the codification. At the time, we had this novel idea that we would just adopt what the ISB had. As you may or may not know, IFRS has a concept of going concern. It is the preparer's responsibility. It is slightly different than what we did in the U.S., and it is a little broader as to how far one has to look. So we decided to accept the principal philosophy in the IFRS's going concern. The unfortunate thing is by doing that, we caused problems in Europe. The reason is a lot of times under the GAAP hierarchy of the ISB, if you look at an IFRS and you're not sure what to do, you have the opportunity to look towards other authoritative standards to provide interpretation guidance. And so most of Europe looked to the bright line 12 months that was in US GAAP, and if we took it out, it would cause a problem. So we decided to kind of rebalance and rethink what we would do. We did talk to the PCC about whether or not there should be a additional assessment of substantial doubt analysis like you have today in the auditing literature, if we should continue that for the accounting literature for private companies. We had to do that for public companies because pursuant to an act of Congress, it is a securities law requirement that auditors assess whether there is substantial doubt. We felt, the majority board felt, that if it was a legal requirement to assess by auditors, then preparers should do it. But we did not at that point think that private companies needed to do that. And the reason was we talked to a lot of investors, and a lot of investors said by the time the information comes out that there is substantial doubt, they've either shorted the stock or sought repayment of debt, and so that particular aspect was not relevant to them, and we did not want to require the additional burden to private companies because there was a legal requirement for public companies. We've gotten a lot of feedback. A lot of large accounting firms think that we should make it consistent for both public and private. A lot of people are concerned about the additional disclosures that would be required for private companies to talk about risk. And what will occur next in the process is the board will get all the feedback, the PCC will get all the feedback, we'll have an open dialogue with the PCC to get their views on what we should do for private companies, and then the board will undertake to resolve that project. I got off easy.
I think you did, Russ. Well, you know, we really appreciate you making the long trip that you made all the way from the East Coast, and I think you've given us a great idea of what's going on in Norwalk. And safe travels home, and you're going to be here for a few minutes in case anybody has some questions. So why don't we go ahead and take our 15-minute break now, which means that we're a few minutes ahead of schedule, and we'll reconvene at 10 o'clock.